Welcome to your final financial stop, where today we're going to be talking about the Federal Reserve, what it is, how it works, and how it affects your wallet. If you'd like to learn anything from this video, share, subscribe to my page. Follow my Twitter, leave a comment, I'd be happy to reply. And lastly, follow my Patreon if you want to learn more information just like this so that you can grow yourself into a financially free individual. The Fed's purpose is to manage the national money supply and influence short-term interest rates while supervising and regulating its banking systems. This assures safety and efficiency of payment systems by processing trillions of dollars of transactions. The U.S. Treasury uses the Fed as a checking account, depositing and withdrawing funds for federal tax deposits and government expenditures. The Fed also sells securities like Treasury bills, notes, and bonds for you to invest in. And there are 12 banks, each responsible for member banks in its district. This breakup of responsibility was based on population distribution of the United States when the Federal Reserve Act was passed in 1913. The bank president is nominated by that bank's board of directors and is approved by the board of governors. They are appointed by the president and approved by the Senate. Member banks cannot change this type of organization of the Fed, but can vote for 6 of the 9 directors on the board of that bank. 38% of commercial banks out there are members of the Federal Reserve System. Member banks have a series of requirements to fulfill, and one of those being owning 3% of the stock of that regional Federal Reserve Bank. But they do get paid dividends for holding on to it, so the incentive is there. There are a few problems though. The Federal Reserve hardly ever reaches its goal of greater financial stability and lower inflation. After the crash of 1929, they continued to decrease the money supply and refused to save banks on bank runs. By decreasing the money supply, it became harder to obtain a loan, therefore raising the interest rates. One of the reasons why the Federal Reserve fails is because it's in part ownership of the public as well as the government. Cryptocurrency is one of the first platforms where the power belongs to you and not the government, or at least right now. It's said to combat inflation as well as return you a higher APY than most standard savings accounts. Banking institutions are required to hold reserves, known as federal funds, which are amounts of currency in their vaults or with deposits in the Federal Reserve. This number is only a fraction compared to what they have in liabilities owed to customers. Because excess amounts in these accounts accrues no interest, banks usually invest the majority of those funds, whether it be in corporations or life insurance. And borrowing from the Federal Reserve has its own interest rate, called the discount rate. So earlier I mentioned the Board of Directors and Board of Governors. Well, the Federal Open Market Committee is a part of the Federal Reserve. The president appoints 7 members, known as the Board of Governors, and then the president of the Federal Reserve Bank in New York, as well as 4 other presidents, meet and manage open market operations. They have 8 meetings per year to discuss monetary status as well as long-term price stability and economic growth. The Government Accountability Office has the power to audit the Federal Reserve banks. They can audit cash storage, bank functions, but they cannot audit foreign central bank transactions as well as decisions of the monetary policy. The GAO is to ensure policies of consumer protection and financial equality. They do this by making sure the Federal Reserve banks supervise about 900 state banks and 5,000 bank holding companies. So how does the Federal Reserve influence you? Well, in mid-December 2021, Jerome Powell, chair of the Federal Reserve, announced that Fed's considering 3 interest rate hikes in 2022 and 3 more in 2023. So the Fed could raise these rates, or the government could reduce their budget, or raise taxes. But no one wants to vote for higher taxes. There are a lot of ways that you can make money as well as lose money when interest rates are being affected, especially in the stock market. When the federal funds rate increases, more often than not, so will the discount rate and the prime rate, as well as mortgage, credit, and auto rates, as well as interest for companies borrowing, leading to higher costs affecting earnings for them and costs passed down to you. Companies tend to take a loss through some type of correlation to the federal funds rate, so that could result in a drop of their total market value. So keep an eye out for press releases from financial or political officials. Sometimes a decrease in rates can cause a drop in the market's value as well, and sometimes that interest rate change is already factored into the price you see today. Most valuations don't even fully affect the market until 12 months after it's been passed, and by then it might have changed already. So remember that the Federal Open Market Committee meets 8 times a year to discuss the monetary policy. Stay alert of rates on your present and future loans, and switch providers if it'll save you the money. So thank you for joining me today. If you'd like to learn anything from the video, share, subscribe my page, follow my Twitter, leave a comment if you have any questions, I'd be happy to reply. Follow my Patreon if you want to learn more information just like this on a deeper level so that you can become potentially financially free. Have a good day.